The way I look at the third quarter is the fact that we do see clear signs that we are recovering from the lockdown of Q2. And we can see that in the commercial evolution and activity of our results. For example, the fact that domestic payment volumes have started to normalize, the fact that, for example, the number of new to customer primary customers have grown by 200,000 customers. And I think the biggest indication of all is that the non-performing loans within the bank actually has not risen between Q2 and Q3. In fact, that's why the risk cost that you see in our results actually dropped from 1.3 billion euros in Q2 to about 470 million euros this quarter. So I think clearly Q3 shows the clear indication of recovery. So I think we're quite pleased about it.
But how does that tie into the macroeconomic backdrop? Of course, we did see a bit of a bounce in activity overall in the third quarter, but now there are further restrictions being introduced on the continent. What does the outlook look like going into the fourth quarter? And are we likely to see an uptick yet again of loan loss provisions like we saw in the second quarter?
I think if our view is that the second lockdown that we already see happening in a number of our major markets will not be like the first. The first one was a bit of an unknown of what would happen. I think we are, shall we say, more knowing what the drill will be. The government support are still in place, supporting a number of our sectors within Europe and across the world. And so we are cautiously optimistic that the second lockdown will not be as bad from an economic perspective as the first. But that remains the case that we remain quite cautious. We remain cautious in terms of managing our credit book. And we have actually quite strong capital ratio. You see that as we announced in the third quarter, our capital ratio actually increased from 15% of core tier 1 to 15.3%. So very strong capital going into what's coming over the winter months.
And actually, I just wanted to pick up on that point vis-a-vis the capital buffer. You have reiterated your long-term ambition of 12.5 percentage points. Are you being cautious with your capital simply as a function of the environment and in expectation of further regulatory crackdown due to uncertainty of dividends and the outlook, given how complicated the macro environment is right now?
Yes. As part of our third quarter announcement, we did announce a new capital target, as you mentioned. We are lowering our capital target from 13.5% to 12.5%. I just want to caution that this is a long-term target, and we will take time to get there to make sure we see visibility coming out of the corona crisis first. And we have also, at the same time, announced a new dividend policy going from previously a progressive dividend policy to a payout ratio of 50%. So these are some of the announcements that we have made. But of course, we want to be taking our time to get there, making sure that we go through the corona situation in strong shape as a bank.